Hello, and welcome to today's life insurance and taxation module exam prep bootcamp. My name is Sam Albanese, and I will be your instructor for today. Because this is an exam prep type of seminar, basically, I strongly urge that you have a pencil or pen or paper available, because we will be referring to some sections in the book that you may want to refer to, obviously. So I will be telling you where the answers are, basically, in the module, in the life insurance module. And also there'll be some formulas that you should know. So I strongly recommend that you have something that you could write things down, so that way for future references and everything else. Now, again, I'm going to try my best to answer questions as we go along. However, as always, time does not permit to expand too much on some of these questions and everything. So I urge you to check your email address on your contact page of your website. And like I said, you can always email me, and I will do my best to respond back to you within 24 to 48 hours. Okay. So let's get ourselves going, because we do have 30 questions. Some of them are relatively short, some a little bit longer. So once again, I'm going to give you some time to read the question on your own. Then, of course, I will read it as well, summarize it for you, and then, of course, we'll give you the actual answer. So let's get ourselves started. So the first question is about Sophie and Daniel. So once again, I'm going to give you a few moments just to read it on your own. Okay, so what we've got here, Sophie and Daniel, they've got 3 children, 10 years of age, and of course they're both working, so they have the daycare needs and everything else. And they figure that they're going to need that service for about 10 years. They also have a mortgage, which is got about 22 years left in the amortization period and everything. And of course, before Daniel actually met Sophie, he was married to Veronica. And in their divorce agreement, what they've got is, of course, spousal support for up to the age of age 60. So you can see that all of these things here basically tend to have a temporary need. Okay, so the question here is, which of the couple's needs are not covered by decreasing term insurance? In other words, if you were to sell decreasing term insurance, given the circumstances that are in front of you, what does it cover and what does it not cover? Okay. And obviously, it will cover the child care, it will cover the mortgage repayments, spousal support. Those are all what we call decreasing needs, because as time goes on, like 10 years from now, they won't need child care anymore. 22 years from now, the mortgage will be paid. At age 60, Veronica will have been paid off, the whole bit. So really, the only thing that decreasing term in this particular situation, the only thing that it doesn't cover, of course, is final expenses. Okay, final expenses, we don't know when the person's going to die. So the last thing you want to do is to buy decreasing term insurance, which by its very nature, of course, has an expiry date, but also it decreases year by year by year. And so therefore, whenever you're talking about estate issues or final expense issues, because none of us know when we're going to pass away, then permanent insurance is the only answer when we're talking about estate needs and everything. Okay. And if you're looking for what section that particular subject is talking about, it's in chapter 2, and section 2.8.2 is the section where they talk about that kind of thing. So chapter 2, 2.8.2 will give you more information about what we just talked about. So let's go on to number 2. And we've got Jackie and Joel. And once again, I'm going to give you a few moments to read it on your own. Okay, so we've got Jackie and Joel here. They own a business, graphic design business. They've been working together for over 10 years. They're getting along obviously very well. And Jackie is married to Vernon, her husband, basically, and is a truck driver. He's got no education, no any experience in graphic design and business management and all that. Okay. Jackie does not have a will. And also, there is no buy-sell agreement between the two business owners, Jackie and Joel. So the question here is, what is the biggest risk for the company should Jackie die? So that's a big issue here. That's what we've got here is two people that are getting along just fine. But remember, because there's no will, basically what will end up happening is that when Jackie dies, the first thing that happens, of course, is that Vernon will take over the business and everything. The problem with that, of course, is he doesn't know anything about the business. Okay, and so the issue now is what are we going to how are we going to solve this particular problem? And so what will end up happening, of course, is what we call family interference. In other words, because there is no direction here, okay, there's no will, there's no buy-sell agreement. Vernon now takes over the business. Vernon and Joel now are partners. Vernon doesn't know anything about the business. So the end result is that the system could collapse simply because they won't get along. Okay, so while creditors, of course, could step in and be concerned about the fact that Vernon doesn't know anything, still that could be solved. Okay, loss of skills, that still could be solved. We could hire somebody with those skill sets. Capital gain taxes, well, there's no sale here, so therefore there is no capital gain taxes. So really, the real issue here is because they don't have a will and because there's no buy-sell agreement, should Jackie die, what will end up happening is that there could be a situation of tension, between Joel and Vernon, and of course, which ultimately leads, of course, like I say, to family issues and so on and so forth. Okay, this particular section is covered on chapter 8. Chapter 8 is very, very important. I stress to you, please, that's on business insurance, so you really should read that particular section because there are a number of questions on the provincial exam that are also involved with businesses and everything else. So that is on chapter 8, 8.1 to be exact. So let's move on to number 3, and we've got Tom and Rita. So once again, I'll give you a moment to read it. Okay, so Tom and Rita are married. They have a high balance in their RRSPs. They have named each other as beneficiaries on their RRSPs. Also, they own rental property on a joint basis. However, the couple is worried that they will have to pay a considerable amount in taxes in the event of their death. So Tom and Rita will not be able to pass on their entire estate to the inheritors, as they might have to sell some of their assets to pay the tax. They have heard of life insurance as a solution for estate preservation. The word estate preservation, this question is very, very important. Okay, it's obviously here, whenever we're talking about estate issues, we're always talking about permanent insurance. Okay, so given that circumstances, what kind of policy will best fit Tom and Rita to cover the taxes on death? So whenever we're talking in terms of a husband-wife situation, and we're talking in terms of an estate issue along with that, usually what will happen is that, like we all know, in a spousal situation, when one spouse dies, the other spouse, the surviving spouse, automatically steps into the deceased spouse. So in other words, there's a spousal rollover. So theoretically, you could defer the taxes until the second person actually dies. And that's why in this particular situation here is when both of them basically leave this earth, you might say, what they need is a joint last to die policy on both Tom and Rita. Okay, it's because there is no tax implication here when the first person dies. Essentially, like I said, whichever one of them dies first, the other one will automatically inherit the RSP because they're the beneficiaries. The property is owned on a joint basis, so automatically that goes over to the spouse as well. So therefore, like I said, on the first death, there really is minimal or virtually no tax whatsoever. They can defer that tax. However, on the second person dying, obviously everything comes together, and CRA, then it's okay. There is no more deferral. So if you want to preserve your estate, you you're going to have to give us the money one way or the other. The best way then to insure a person for estate purposes is joint master die policy. And usually, by the way, the product that we recommend in a joint master die policy doesn't have to be this product, but it's usually one of the better products is term to 100. You can always use universal life. You can always use whole life, participating or non-participating. In other words, any permanent insurance will do for estate preservation. Never, ever, ever use term insurance for estate preservation. Always use permanent insurance. But like I said, the question doesn't go that far, but I wanted to let you know that that is the preferred product when you're looking at estate situations is term to 100. So for further information on that is chapter 2, and it's chapter 2.2, section 2.2. Basically will be the area that they will discuss this particular situation. I can assure you that usually is a question on both is the certification and provincial exam that covers this particular area, so please pay attention to it. Let's go on to 4. It's rather long, so I'll give you a few extra moments to read this. Okay, so to summarize the question, it was determined you were sitting in front of your client there, Yvonne and Alan, and you determined that Yvonne needs $2 million worth of coverage. That's so your preliminary investigation. Basically, objective was that should she pass away, they need $2 million. However, upon further investigation, you discovered that Yvonne already has $600,000 on her life, and Alan is her beneficiary. Also, her employer has $500,000 with the coverage, but the employer, of course, is the beneficiary in this case here. Okay. We also know that Alan, who has a group insurance policy, is covered under a group insurance policy, but his job is going to be terminated. So even though Yvonne is covered for $25,000, the problem is that his job will be terminated, which basically means that the group insurance coverage, the $25,000, will also be eliminated as well. So the question really is, in order for Yvonne's family to maintain their current lifestyle, what amount of life insurance coverage should Yvonne purchase? So let's go back for a moment. We established the fact that she needed $2 million for the coverage. However, we did establish the fact that she already owns $600,000. She already owns $600,000. We also said that the company owns $500,000 on her life. Even though there's $500,000, Alan doesn't get any of that money. That is corporately owned insurance, and when she passes away, the corporation will actually get that $500,000. So therefore, we cannot factor the $500,000 into this thing here. So that's a no-brainer. We can't use that. The other thing is she's got $25,000 for the coverage with her through her husband's group insurance plan. But remember, he's going to lose his job. So that plan, that's gone as well. So we can't use that either. So the end result is that only thing we can use is, yes, she needs $2 million. Yes, she has $600,000 already. So therefore, what she's entitled to is $1.4 million. In other words, the additional amount of insurance that she needs now is $1.4 million. It's very important that you read these kind of questions very, very carefully, because the initial thing is, well, the $500,000. So she's got $1.1 million already. She doesn't have $1.1 million. Yes, she does have $1.1 million, but it goes to two different people. So we're looking at a situation here where she wants to maintain this for her family and everything, and so it is important that you factor that in. So that is also on chapter 10. Chapter 10.4.3 is the area that you're going to be seeing that kind of thing there. It's on chapter 10, section 4.3 is where you're going to get that kind of information. Let's go on to number 5, and we've got Alan. Okay, so what we've got here is Alan. He's got a $500,000 whole life policy. He pays $3,000 a year in premium, but it was due 10 days ago. So in other words, he hasn't paid it. There is a $75,000 cash surrender value, and the ACB is $30,000. However, he has an outstanding policy loan of $30,000, and also on that $30,000, there's $4,000 worth of interest that is accumulated, basically. So if he dies, the question is, of course, is how much money will the beneficiary actually get? So in this case here, if you have a pencil handy, I should write this down, because in this case here, what you've got is two actual pieces of information that you need. First of all, we have to calculate the proceeds of disposition. And the proceeds of disposition in this case here is the cash surrender value, which in this case is $75,000, minus the $30,000, of course, which is the policy loan, which is, and then minus again the $4,000, which is the accrued interest, and minus also that the amount of money that he owes in terms of the premium that he never actually paid. And so for that 10 days, basically, he should be paying $80. Okay, and that's he hasn't paid that. So what happens here is basically the proceeds of disposition based on $75,000 minus the $30,000 minus the $4,000 that he owes in interest minus the $80,000 that he owes in premium. Okay, and so therefore the amount of proceeds of disposition will be $40,920. Okay, so that's the proceeds of disposition. However, the question is asking you what are the taxable situation here. So it's not asking you for the proceeds of disposition, although we need to calculate that first in order to figure out how much the tax is actually involved. So the policy gain is the next one, and the policy gain is the formula for that is proceeds of disposition, which in this case here, if you remember, was $40,920 minus the ACB. And in this case, the ACB was $30,000. And so therefore, the first $30,000 is tax-free. The difference between the $40,920 and the $30,000 will be the policy gain. And so therefore, $10,920 will be what he will have to pay tax on. So I just want to quickly review that, because this is a very, very typical type of question that appears on the exam on more often than you will. So he has $75,000 in cash sitting in there with $30,000 of the ACB. However, he has a policy loan of $30,000 and $4,000 of accrued interest, and on top of that, he also owes $80 for the 10 days he hasn't paid yet. So the end result of all this, that the proceeds from this position is the $75,000 minus the $30,000 in loan, minus the $4,000 of accrued interest, minus the $80. So that's their proceeds of this position, and that comes down to $40,920. The ACB is $30,000. So the difference, the ACB, which is 30, and the $48,920 is $10,920. That amount of money will have to be basically put in his T4 when he gets his his taxes and everything else. He has to pay tax on that amount. So it's very important that you understand how that works, and that is very well explained actually in Chapter 7. Okay, Chapter 7, and it's Section 3.1. talks about this very, very subject. So strongly recommend that you review that for exam purposes. Let's go on to number 6, and we've got and. So we've got Anne. She's got a $50,000 policy loan on her whole life insurance policy, basically to start a business. At the time, the policy's ACB was $40,000 and the cash surrender value was $70,000. Today, she wants to repay that $15,000 of the loan capital and $5,000 worth of accrued interest. In other words, she wants to deposit $20,000. Okay. So the question now is, how much of her repayment will she be able to deduct for income tax purposes? Remember that when you take out a loan and then you pay that money back, okay, basically your ACB will go back up again. So when you took out money, your ACB is dropped. Now when you put the money back in again, your ACB will go up. So the question here is, how much of her repayment will she be able to deduct for income tax purposes? Remember that when she took out that money, she did have to pay tax. Okay, there's no question about that. Okay. So when Anne took out the $5,000 policy loan, it resulted basically in a policy gain of $10,000. So she obviously had to pay tax on that because the ACB was 40. She took out 50 as a loan. So she's got a gain of $10,000. So she had to pay tax on that. So now that she decided, okay, I now have the money, I want to pay all of it or a portion of it back, whatever. So in this case here, it's going to pay $20,000 back. That basically means that she can now deduct from her taxes $10,000. In other words, she gets a recovery. So basically, she paid tax on the $10,000. Now the fact that she paid the loan back, she has an opportunity to deduct that $10,000 from her income tax form, and so therefore she gets basically like a credit. So again, it's very important that you understand this concept of that when you take out money, you'll have to pay tax on the gain. But if you repay that loan, okay, whatever amounts that you repay, you repay all of it or a portion of the loan or whatever it is, whatever you ended up having to pay tax, that all of that money will be refunded back to you at the when you actually pay it back. So in this case here, that $10,000 will be a deductible expense to her, and so that basically means she's going to recover back the taxes that she actually paid in the first place. Okay? And that is very well explained in Chapter 7 of the book. In Chapter 7, 5.1 is where they talk about that. Chapter 7, 5.1 is where they talk about that particular subject. Okay, okay, oops, sorry about that. Philip, age 45. So what we've got here is Philip, he's age 45, and he obviously believes in the importance of insurance. He's got a son who he wants to insure. He's a 7-year-old son, he wants to insure him. And as it says, it's important for Philip that his son Nicholas is covered for life, but he does not want Nicholas to be burdened by payment of premiums once he's assigned a policy as a young adult. So let's say, when he's age 18 or 20 or whatever it is that he decides to transfer the policy over, he wants to make sure that that policy is fully paid for, basically. Right? He would also like the amount of coverage to increase over time because he realizes that the value of the dollar today will be lower many years from now. So we've got two objectives here, okay? Basically, he wants to make sure that his son will be covered for the rest of his life, but does not have to pay any more premiums once the policy is transferred over to him. And the second objective, basically, is to make sure that the amount of coverage increases over the years, but once again, without having to pay any additional premiums. So obviously, the question is which policy is best to cover the Phillips objectives. And in this case here, it will be a 20-year pay participating whole life with paid up additions. So it's not T100 because T100 basically is term insurance permanent insurance, but his son would end up having to pay premiums until the day he dies, basically. C can't work because it's a participating whole life policy to age 65 with paid up additions. Remember, he said he wants to make sure that when he transfers the policy over, when he's a young adult, not age 65, but when young adult, there'll be no further premiums to be paid. And so therefore, that's not going to work either, okay? And then on D, 20-year pay, non-participating, once again, non-participating won't do it. Because while, yes, it's payable for 20 years, it is non-participating, which means that there are no dividends. And therefore, you cannot buy paid-up additions. You cannot buy paid-up additions. That's the important part. And that's why the 20-year participating policy, whole life policy with paid-up additions So the premium is paid at the end of 20 years, but because it is a participating whole life, he can use the dividends to buy paid up additions, so the insurance will increase over the years without his son actually having to pay any more premiums. So we've met the two objectives that Philip has by offering this particular product and not the other product, and that is explained on chapter 3. Okay, chapter 3, section 10 is where they talk about that kind of a scenario. Okay, let's go to question 8, and we've got Jeremy. So this is pretty straightforward. Jeremy has a participating policy, and he's chosen the cash dividend option. So in other words, send me a check every year, basically. That's it. So this year's annual dividend was $10,000, and his policy's adjusted cost base is $4,000. What will be Jeremy's policy gain, policy dividend? Well, basically, it's quite straightforward. It is the ACV, which is $4,000, minus the $10,000, which is the actual dividend. So there was the proceeds of $10,000. The ACV is $4,000. So therefore, he has to report $6,000 as taxable income and pay the tax according to his marginal tax rate. Okay? So that's quite straightforward. So whenever you get a question about dividends, they usually will give you the ACV. So essentially, the difference between the ACV and the dividend, that portion is a gain. They have to put that on their T4 at the end of the year, basically the T1, and pay the tax accordingly. And that is discussed quite extensively on chapter 7. Chapter 7, point 2, where that section there talks about dividends and taxation of dividends. So chapter 7, point 2 is where you need to go for that. Okay. Let's go to 9, and here it's a little bit long. So once again, I'm going to give you a little extra time to chew over this one. Okay. Okay, so what we've got here is Lauren. She's got $3,000 in checking account, $20,000 in savings bonds, $100,000 in RSPs, $50,000 liras, $45,000 TFSAs. She also has an unregistered portfolio of $75,000, where the adjusted cost base is $25,000. She estimates that it's going to cost about $10,000 for final expenses in the event of her death. She also has $100,000 in debt. She wants to make sure that her retirement savings and other investment assets get transferred to her husband upon her death, but expects that her liquid assets to be used to help pay her final expenses and debt. She also is eligible, of course, for CPP. So the question now is, how much life insurance does Lauren need to ensure that her final expenses and debts are fully covered? Okay. So once again, we're looking at a situation of how much is the debt. So in this case here, the debt's $100,000 plus $10,000 worth of final expenses, so it's $110,000. Okay? And so therefore, the total debt is $110,000. However, remember, she does qualify the maximum for CPP, and the maximum CPP is $2,500. So therefore, she's going to get $2,500. So you can deduct that $2,500 from the $110,000. Also, she can use the $3,000 in her checking account. Remember, she said she can use the cash that could be used to cover off her final expenses. She also has $20,000 in Canada savings bonds. She can use that. In other words, all this non-registered money, so to speak, liquid money, basically can all be used. So if you take the debt, which is $110,000, minus the $2,500, minus the $3,000 from cash in the bank account, minus the $20,000 in her savings bonds and everything, really all she really needs is $84,500. So this is really a classic case of assets minus liabilities. Okay, the liabilities are $110,000. The assets are $2,500 plus $3,000 plus $20,000. You take those into consideration. and it becomes 84,500. That's all the amount of insurance that she needs to make sure that all of her final expenses are actually met, and therefore they don't have to cash in the RSPs, they don't have to go into the TFSA, the non-registered portfolio, all that stuff there. Because remember, she wants to leave all that money to her husband. Okay, so question 10, Rodney. And it's a little bit long, so once again, I'll give you a few extra moments. Okay, so we got here is Rodney. He wants to make sure he has enough life insurance to replace his income until he reaches age 60. So he's concerned about prematurely passing away. Okay? He also would like to ensure that the impact of income taxes on the investment income on death benefit is taken into consideration, as well as the impact of inflation, because he does not want his wife's purchasing power to be diminished. Okay? So although Rodney wants to make sure he has sufficient coverage, he does not want to buy more life insurance than what is needed. In other words, I don't want to be overinsured. I just want to have enough to be able to cover all of this, and factoring in, okay, the fact that he wants to make sure that it's adequate until he reaches age 60. So one of the things we look at here is, why should the income replacement approach not be used to analyze Rodney's insurance needs? Now remember, the income replacement approach says basically is, what is your income? And then we divide that by the real interest rate, and that is the amount of insurance that you need. The problem with the income replacement approach is that it assumes, that the amount of money will be needed in perpetuity. Okay, so the end result is that the answer in this question is A. Okay, because the income replacement. So if you take your amount of money you need, let's say the 50,000 or 100,000, whatever you need, and you divide that by the appropriate real interest rate, it assumes that forever and a day you're going to need that money. Okay? In this case here, he says, no, I'm not going to need that forever. I'm only going to need that until I reach age 60. After that, I don't have to worry about it. So therefore, the used income replacement assumes the income needs to be replaced in perpetuity is the not answer. Okay, the other ones are the ones that he does need. It does not take into consideration the impact of income taxes on investment return. Okay, that of course it does factor in. In other words, the income tax does have a major impact on the amount of return that's going to be needed. Because if you're going to invest money, obviously you have to pay tax on any investments. Okay, it does take into consideration inflation and investment returns and everything. So the thing that it does not, okay, is assumes the income needs is to replace in perpetuity. Okay, and that is covered actually on chapter 11. Okay, chapter 11, 2.4 is where the what that particular is needed. Okay, so question 11, we've got Ronnie. So Ron does not have any personal life insurance. The coverage offered by his employer is sufficient to cover insurance needs. Also, if Ron leaves his employer, he can convert part of his coverage into permanent insurance, obviously with no medical evidence and all that sort of stuff. His life insurance agent discusses the vulnerabilities of Ron's group coverage to ensure Ron knows the risk of having group coverage only. In other words, what is the issue here with just having group insurance? Now, you're going to run into this in real life. A lot of your customers are going to be, a lot of your clients are going to say, oh yeah, well, I've got lots of coverage from my employer, so therefore I don't need you and all this. Well, there's lots and lots of vulnerabilities here. Okay? Which amount of the following is not a vulnerability of Ron's group insurance? So the not question again. Okay? If there's a claim following Ron's death, it may be refused due to post-claim underwriting. In group insurance, there is no post-claim underwriting. Okay, so you do not have to worry about a situation where they're going to ask a whole bunch of questions once the person passes away. So group insurance does not have post-claim underwriting. So this is something that Ron does not have to worry about. That because I'm covered, and they never asked me any medical questions when I was employed. That means they're going to ask medical questions when I die. And they could refuse the claim. No, in group insurance, there's no underwriting when the person dies. Okay. However, where he is vulnerable is the amount of coverage is quite limited. Normally what happens is it could be a flat amount, 25,000, 50,000, maybe one-time salary. It is pretty limited. Okay. The premiums upon conversion. So yes, you can convert his policy if he ever leaves employment, but those premiums aren't guaranteed. So I can't tell you what the premiums are going to be 20 years from now, 5 years from now, 2 days from now. I can't tell you that. Okay. So the premiums will go according to the date that they actually convert. So therefore, it could be astronomically expensive and everything else. So that's a very strong vulnerability. And the last thing, of course, is he doesn't have any control over his policy. Remember that the employer on group insurance is the only one that has the control. So if that employer decides, look, this is going to be too expensive. I don't think I'm going to proceed any further. This is going to cancel the group insurance plan. Guess what? That is the end of Ron's insurance. And what if Ron now is uninsurable? And suddenly the insurance company or his employer says, we no longer have group insurance, you're on your own, and he's uninsurable. Now he's really has a problem. Okay. So usually we recommend that group insurance should be an additional thing. It's a nice thing to have and all that. It's relatively inexpensive, but you really should have your own private plan because you have all the controls that you want. You can do whatever it is that you want as long as you're paying your premium. With group insurance, you're not in control. The employer's in the control. And if they decide to cancel, then you're basically out of luck. So if you're uninsurable, that's the end of that. Okay, so nice thing to have, relatively inexpensive, but not secure in that sense. Look at all the people lose their jobs all the time. So look at the people, for example, Sears Canada. 16,000 people have lost their jobs. Those benefits are gone. It's as simple as that. Okay, so keep that in mind, and you may want to remind your clients of that kind of situation. It could happen to them as well. Anyway, let's move on to number 12. Assume that all the following individuals are eligible to apply for life insurance with ABC Insurance Company. Which one is most likely to have the lowest maximum coverage available? So before I answer, let's go through A first. The civil engineer who is waiting for permanent residency. So basically, the Immigration Act wants very well educated, highly qualified individuals. So obviously, a civil engineer will get the maximum coverage, even though he only has permanent residency in Canada, not really a citizen yet or anything. But because he's an engineer, essentially he's going to get the top marks, okay? Because of the fact that he is a highly skilled individual and everything. A Canadian citizen who travels 5 times a year to the Middle East for his job, the fact that he's a Canadian citizen, okay, still gives them the maximum amount of coverage. However, he is going to a dangerous area, so there may be some exclusions. So the Middle East, as we all know, is a powder keg, and so therefore, even though he's a Canadian citizen and therefore entitled to have the maximum coverage available and everything, the fact that he is going to the Middle East, that's going to create a problem right there. In that the insurance company say you go to a war zone, it's an exclusion. We're not going to pay you if you go to an excluded area. Okay, see. A qualified commercial plumber who is waiting for permanent residence in Canada, it will not be as high as the engineer, but still a plumber is a qualified individual. In other words, he still has a strong skill set, so he will get a reasonable amount of money as well. However, the nanny, who is at the bottom of the pay scale, basically will probably get the least amount. Okay, that nanny will in fact get the least amount, because that person is not a highly skilled individual. They're not plumbers, they're not engineers, they're not doctors, they're not professors. None of these things here. And so A, B, and C, they'll still get a reasonable amount of coverage and everything, but the nanny will be the one that will get the least amount of coverage, or the lowest amount of coverage, because of the fact that usually, unfortunately, nannies are not highly qualified. And basically, they are domestic labor. And so therefore, they will not qualify for the full amount. They'll get something, but it'll be a very, very low amount. because the risk is simply too high for the insurance company. Let's go on to 13. Oh, basically that previous question there, by the way, that was on chapter 10. Okay, chapter 10, 4.3 is the area. The other is on as far as question number 2, question number 12 rather, is on chapter 9. Chapter 9, section 4.9 is for question number 12. Okay, and now we're on question number 13. And again, I'll give you a moment to read that. So here we've got James. He has an after-tax income of $65,000 per year. His wife earns $100,000 a year, resulting in an average tax rate of 30% and a marginal tax rate of 44%. James wants enough life insurance coverage to replace his after-tax income if he does. This is important because it's an after-tax income if he does. So assuming an annual rate of return of 4%, ignoring inflation, so it's not inflation plus after-tax, strictly after-tax. This was only one piece of the formula. And use the income replacement approach, calculate the amount of life insurance coverage James will need. Okay. First of all, I want to give you this section. This is very, very important. You will get this kind of a question on the exam. The section is section 11.2.3. So chapter 11, 2.3 is where this comes into play. Okay. So basically, the first thing we have to look at is how do we calculate the after-tax rate of return? Okay, the after-tax rate of return. So if you have a pencil handy, you should write this down. Okay. So the formula for the after-tax rate of return is equals to the rate of return, which in this case, of course, is 4%, okay, times 1 minus the tax rate, okay, minus the tax rate. So in this case here, it will be 0.04 times 1 minus 0.44, remember 44% is a 4.44. So you multiply that out and you come out to 0.0224. So in other words, the after-tax rate of return is 2.24%. The pre-tax is 4%, but he wants it after-tax. It's in a 44% tax bracket. So therefore, what you have to do is you've got to take the rate of return, which in this case is 4, times 1 minus 0.44, and you do all that math, and you'll see you get 0.0224. So now that we know the after-tax rate of return, which is, like I say, 2.24%, now we can take the $65,000, which is the after-tax income that he wants to make sure that his wife will get should he pass away. So you take the $65,000, divide that by the 0.0224 or 2.4%, and you get the magic number of $2,901,786. Okay, this is again a very, very important calculation. This is an after-tax income, so always remember it is the rate, okay, times 1 minus the marginal tax rate, which in this case is 44%. And so that brings it down to 2.24. Divide that into 65,000, and you'll get $2,901,786. And that is, as I said, on chapter 11, section 2.3. Strongly urge that you review that because it usually a very strong exam question on for you. Okay, let's proceed to 14, and we've got Pamela. Okay, Pamela wants to know the difference between a rider and a supplementary benefit as she hears her agent using both terms. We usually sort of interplay, you might say, these, and we say, riders, sometimes they supplementary benefits, sometimes we say riders, okay? So they're sort of interchangeable and everything else. But basically, riders provide additional coverage when a person dies. Okay, so the idea of a rider is to provide additional coverage when the person actually dies. Supplementary is to provide benefits when the person's actually alive. Okay, so supplementary, you might say, is a living benefit. riders are death benefits. Okay, so examples of supplementary, for example, would be the accelerated death benefit. Let's say, in other words, if you're terminally ill, you can use ask the insurance company to give you a portion of the death benefit now to relieve financial pressures and everything else, and then the balance will be paid, when a person passes away. So what they call accelerated death benefit, accelerated dismemberment benefits, terminal illness benefits, things of that nature. Those are what we call basically supplementary. In other words, that's while you're alive. Waiver of premium is the supplementary benefit, because again, you're alive doing that. Parent waiver, payer waiver, all of those kind of things are what we refer to as the supplementary benefits, because those are taken advantage of while you're actually alive. Okay. Riders, on the other hand, are when you die. So, for example, GIBs, that's a death benefit. Actual dismemberment, ADB, actual death benefit. Any of these kind of things, paid up addition riders. Any of these things here are what we refer to as riders, because those kick in when a person actually dies. So the answer then is riders increase the death benefit, whereas supplementary benefits provide additional benefits before death of the insured. So supplementary benefits are basically living benefits. Riders are basically death benefits. So that's between one and the other. And that it could be found on Chapter 5. Okay, Chapter 5, Section 5.1. So Chapter 5, Section 5.1 is where that information is found. Okay, so we got Frank. This is just a piece right now. I'll read that and then I'll go on to the next slide. Okay, so Frank and Allison have a participating whole life insurance policy with paid up additions dividend option to cover income taxes that will be due after the second death. So second death insurance, once again. They're concerned that if they live long enough, the taxes owed after their deaths will be minimal, and they will have paid a considerable amount of money in insurance policy they may no longer need. So the question now is, how could Frank and Allison access cash from their policy to recuperate some of the money they have paid as premiums? Okay. So in other words, what they're saying is, we could be paying premiums forever and a day. We get to a point where we probably paid in more money than the policy is actually worth. How can we recuperate some of those while we're still alive? Basically, okay. So the answer is 1, 3, and 4. So in other words, they could surrender part or all of their policy to receive some of the cash surrender value. In other words, they can take some of the cash out right now. Basically, they can certainly borrow money against the policy. That's usually a common way of doing it. In other words, borrow the money now. They don't have to pay it back, and when they pass away, basically it just comes off the face amount of the contract. Okay. And 4, change the dividend option from paid up additions to cash. Remember that the dividend option they now chose is paid up additions. What they're saying is, well, these could add up to a sizable amount, more than we actually ever need. How can, once again, we mitigate that problem? Well, instead of having paid up additions, just phone the insurance company and say, okay, I want to stop the paid up additions, and I want you to start sending me a check every single year. So how they can recuperate some of this money basically is by doing those 3. Surrender some of that money. If it's a universal life policy, for example, they simply make a withdrawal. Okay. If it's whole life, they can't make a withdrawal, but they can certainly get a policy loan. And of course, if it's a participating whole life policy, change the paid up additions into cash, and that way they start getting a check every anniversary of their policy. And that is very well covered actually in section 3, 5.1. Okay, so section 3, 5.1 covers that particular subject. Okay. 16, and we've got Donald, who's 63 years old. Once again, I'll give you a moment to read that on your own. Okay, so what we got here is Donald, 63 years old. He realizes that the chance of him actually getting a job at age 63 is going to be next to impossible. So therefore, he accepts the fact that he's retired and probably never work. So now he's looking for obviously for ways to lower his expenses. He has $250,000 in coverage, and he pays $7,000 in premiums. He also has $120,000 in cash surrender value that's accumulated over the years. So he wants to keep enough insurance to cover his final expenses. By anything beyond that, he would consider an extra bonus for his heirs. So which non-forfeiture option would be the best fit in Donald's situation? Remember that when we're talking about the non-forfeiture options, okay, these are basic ways and means that the client can recover some of their monies and everything else without necessarily canceling their contract and everything. So what we've got here is he's basically saying, I may not need the entire $250,000. I need some insurance for the rest of my life. I know that because to cover my final expenses, but I don't necessarily need $250,000. I would like to be able to stop making those $7,000 payments if I can. So how can I do that? And in this particular case here, you can buy reduced paid up insurance. So basically what would end up happening is with reduced paid up insurance, what would happen is that he would say to the insurance company, look, take the $120,000 as a single premium and buy me enough insurance, okay, that will cover my final expense for the rest of my life and never have to pay another dime. So in other words, the $250,000 could be reduced to $200,000, for example. Okay, so the $120,000 is used as a single premium. However, because he no longer wants to pay any more premiums, he doesn't want to pay any more premiums. So basically, he's saying is take the $120,000, use that as a single premium, but I do want it to be permanent. I want insurance for the rest of my life. So therefore, a reduced paid up insurance does exactly that. It will be reduced, but it will be insurance for the rest of his life, and he never has to pay another dime towards that. The other three won't work, because the other three basically assume that the amount of coverage remains the same. So automatic premium loan, the APL, basically what will happen is the company will deduct $7,000 every single year. So the amount of coverage will slowly decrease over the years. So when he passes away, whatever the loan amount happens to be, will be deducted from the $250,000. Okay, so it's quite possible that he may get to a point in his life where he's lived for a long, long time, and that $120,000 could be completely chewed away, and the policy could lapse. In other words, there's not enough money, because remember, it is a loan. So A and C won't work because both of them are loans, and both of them obviously will carry interest on those. So it's quite possible that over the long run, he could in fact run out of money, and therefore the policy will in fact lapse. B won't work because he wants permanent insurance. The extended term insurance is not permanent. It basically says, yes, we'll use the $120,000. Yes, we will keep your coverage for $250,000, in other words, we're not going to reduce it. However, it's not going to be insurance for the rest of your life. It's only going to cover you, let's say, for 14.3 years. Well, what if he lives longer than 14.3 years? Well, then he's out of luck. Basically, the coverage is finished. He wants something of a permanent nature. So the best answer in this situation here is reduced paid up insurance. You really, I stress to you, you should look at the non-forfeiture options, and they are on chapter 3, section 0.5, section 5, basically. So it covers the non-forfeiture options. So you should make yourself aware that the non-forfeiture options are available on participating whole life policy, non-participating whole life policy, and universal life. So all permanent insurance products that have cash values have non-forfeiture options built into that. So you should familiarize yourself with the needs of that. And that is very well covered on chapter 3, 3.5. Basically is the section we want to be looking at. Let's look at 17. And we've got Philip. It's again a little long, so let's let you read the first section first. Okay, so we've got Philip. He wants to buy a UL policy, and he's looking at saying, well, should I buy the level death benefit, or should I buy the level death benefit plus account value? That's really what the issue is. And so the question is, which of the following statements but the difference between these two options are true. Okay? And so it's 1 and 2. If you buy the level death benefit, the investment amount will increase rapidly. In other words, because there's no additional insurance, in other words, it's just simply level. So let's say you have $500,000 worth of coverage, and it's always $500,000. It never increases. Therefore, the amount of risk never increases. So the end result is that your cash value, the cash that's sitting in your account, will grow faster because the net amount of risk is the same. It's always $500,000. Okay. So from that perspective, that's one of the major benefits of a level death benefit, in that if you're only interested in really accumulating large sums of cash, the death benefit is not as important to you as much as the tax sheltering of cash and everything else, then the level death benefit is very good because the net amount of risk is always the same. Say in our example, $500,000. 2 is also correct, because if Philip feels this insurance needs to be increased, he should choose the level death benefit plus account value option. Okay, so in other words, if he's concerned that over the years his needs may actually be increasing, then option 2 is his best bet. So option 1 says, look, if you're happy with the amount of coverage, but you want to increase the amount of cash level. If you're saying no, the amount of coverage I want is more important, then in that case, then basically it's the amount of level plus account value is the answer for you. And 3 and 4 are not correct. With the level death benefit plus account value upon death of the life insured, I'm sorry, whoever's got a dog or whatever is barking there, I would appreciate if you could do something. I can't seem to turn you off, whatever it is. There's the curbing up. So please, I'm going to try to, not getting anywhere here. Okay. Anyway, my apologies. So 1 and 2 is the correct answer for 17. And that is covered on section 4.4. Okay, chapter 4, and it's 4.4 is the section that you want to talk about. Difference between the death benefit. Remember that on universal life, you've got the 4 death benefit options: level plus account value, level plus return premium, level plus index. This question here, it's a difference between the level plus account value. So please go over to chapter 4.4 for further information on that. Okay. 18, and we've got Kelly. So Kelly is a widow. She owns a cottage on the lake, and she purchased it for $150,000. So that's her ACV, basically, $150,000. Today, it's worth $700,000. And she feels that because of the demand for lakefront property, it's going to continue to increase at the least at the rate of 3% a year. So Kelly plans to bequeath her cottage when she dies to her daughter. She's going to give it to her daughter, Diana. She does not want her daughter to be forced to sell the cottage to cover the income tax that will have to be paid on the capital gain of the cottage when she dies. So which of the following life insurance policy would best fit Kelly's insurance? So as you know, the moment she dies, this is not a spousal situation. This is a children's situation. So there is no children rollover. It's only spousal rollover. So in this case here, when Kelly dies, the difference between what she bought it for, which is $150,000, and whatever it is valued at the date of death, the fair market value, whatever that happens to be, that difference will be subject to capital gains and everything. And so the result of that is that she's saying, well, how's my daughter going to be able to pay for all this? And also, I want to make sure that the amount of coverage that I have will increase more or less at the same rate, you might say, that the cottage value is. And so therefore, in this case here, it is a permanent insurance need. And the best thing for her to do is to buy participating whole life with paid up edition dividend option. So with the paid up edition, as you know, the coverage will increase according to the dividend that's being given every single year. So theoretically, her coverage will increase without ever increasing the premium or anything, but the coverage will increase. A doesn't work because it's 10-year term. She doesn't know when she's going to die. Okay, so term insurance never ever works when we're talking about estate issues. So you need permanent insurance, so it won't work. Universal life with level death benefit, that could work, except that it is level death benefit. Okay, and remember, she wants to make sure that there's enough money to be able to pay the tax, as the cottage value increases, obviously the tax liability will increase as well. So universal life could work if this was level death benefit plus account value, fine. But in this case here, she only chose level death benefit. So that's going to be an issue. That's why that's not going to work. And of course, 20-year term won't work, because once again, she may die after 20 years, in which case then it's useless, absolutely. So whenever we're talking about permanent needs and everything else, we must always look at permanent insurance. And in this case here, whole life with paid up additions is the answer. This is covered in Chapter 3, and it's a Section 3.3. So Chapter 3, Section 3.3 will be where your best bet is. Okay, we've got number 19, and we've got Nathan. Okay, so Nathan's life insurance agent has used the income replacement approach to determine how much insurance that needs. However, Nathan's current income basically feels that it's too simple. In other words, he's saying that's great, except that I'm worried that the analysis doesn't take into account consideration of bill that his income will actually increase over time. So if Nathan's life insurance agent takes into consideration his increasing income, what will the impact be on his income replacement analysis? And basically what we're saying is that the amount of life insurance needed will be much higher. In other words, if he's concerned about the fact that, well, yeah, 500,000 right now sounds like a great number, and I think it's fine. However, what if my income increases and my needs are greater and so on and so forth? Maybe we should be going for a higher amount. So whenever a person expresses concern over future and everything else, one of the things you may want to consider is simply insure him for a larger amount to take into account the fact that his needs will change. Nobody ever was disturbed by the fact of having too much money when they pass away. Okay, beneficiaries want as much money as they can get their hands on. So having excess insurance and everything else never hurt anybody, basically. And so therefore, in this case here, because of his concern, then is basically insuring for a larger amount that will take that into consideration. And that's covered on Chapter 11. Okay, Chapter 11, and the section is 2.2. It's where we talk about future needs and how to rationalize those. And of course, takes into account inflation, things of that nature there. So go to Chapter 11, 2.2, and that'll give you the more information on this particular area. Let's go to 20, and we've got Leon. I'll give you a moment to read this because it is a little long. Okay, so we've got Leon. He's 35 years old. He's applied for life insurance, and he wanted to submit his application obviously before he goes away on a 2-week vacation in the United States. In addition to completing the entire insurance application with his life insurance agent, Leon answers a separate series of questions for the temporary insurance agreement, the TIA. The answer to these questions were all no. Okay, so however, he did not pay any premiums because he wants to know if he qualifies for life insurance before paying a premium. Because of the amount of insurance coverage Leon is applying for, he will have to get a paramedic examination done, including giving urine and blood samples. He asked his life insurance agent to have this scheduled for when he returns from vacation. For which of the following reasons will Leon not be covered by the TIA? Remember, the TIA is temporary insurance. Okay? It covers you for the period of time when the agent leaves your house, you might say, until the agent delivers the policy to you. What if something happened to you in between that? So it is temporary coverage just for that period of time, so a period of underwriting. Okay? And the problem with this issue here is he did not pay any premiums. In other words, in order for the TIA to actually come into force, even though there's no medical yet, he still needs urine and all that stuff there. Those are all fine, okay? You can do those when he comes back and everything. That's not a problem. The problem is that he needs to pay at least 1 month's premium for the TIA to actually come into force. The fact that he's not paid any premium, that means if something should happen to him while on holidays, on his way back, or whatever it is, he will not be covered. There'll be absolutely no coverage whatsoever. In other words, you must have consideration. The only way the TIA comes into force is that you at least pay 1 month's premium. In that case, then, he would be covered while he was on holidays. Okay? When he came back, he go for his blood test and all that sort of stuff. That's fine. But at least he would have coverage while he's on holidays. But the fact of the matter is he did not pay any premium, so therefore the TIA is not in effect. So should something happen to him while he is on holidays, there will be absolutely no coverage whatsoever. Okay? And so that is covered Chapter 9, 3.1. Basically, the fact that he's spending 2 weeks outside of Canada, that's not an issue. Okay, you're covered 24/7. Basically, that's not an issue. Okay, he did not get his paramedic again. That's not an issue. The real issue is that he did not pay any premium. He's too old, but he's 35. TIA, generally speaking, will be issued up to age 70. Sometimes, depending on the company, some companies will not issue a TIA beyond age 60. Some will go to 65, 70, whatever. But in this case here, he's not too old, obviously. Okay, so really, by postal elimination, C is the correct answer in this case here. So again, I refer to Chapter 9 and Section 3.1 talks about the TIA. There is always a question on the exam on the TIA because it's a very, very important part of the underwriting process and everything else. Okay, so a stress to you, please make sure you read that section. 21, and we've got Laura and Kathy. Okay, so we've got Laura and Kathy. They have an accounting firm. They're both personally responsible for the business debts and obligations, and each receives 40% of the profits. Okay, so the fact that there says here that they are both personally responsible for the business debt means that this is not a corporation. It is a partnership. Okay, so whenever you see the word that they're both personally responsible, that means it's not a corporation. It is a partnership. Okay, and so each receives 40% of the profit. So they share basically 40% of the profits. Okay, Laura's uncle Raymond invests capital in the business, but he's not involved in the day-by-day operation. So he's just simply an investor, and he receives the additional 20%. So in other words, 40 go to Laura, 40 goes to Kathy, and 20% of the profits will go to Raymond as the person who's actually financed this whole thing. But he's not personally responsible for the debts or other obligations of the business. Okay, so which of the following statement is true? So basically what we're saying is that Laura and Kathy are general partners because they are personally responsible. So whenever you see the word personally responsible, basically means two things. First of all, a partnership, and number two, they are general partners. The fact that Raymond is not involved in the day-by-day operation means he is now a limited partner. In other words, he is limited. The exposure basically is limited to the amount of money that he's actually invested. So he's not responsible for any debts or anything. He is simply an investor, and that's it. So the banks can't go after Raymond and say, look, Laura screwed up, and they owe us money, so you pay up. He's not responsible for any debt. So the general partners are responsible for all of the debt. Raymond is a limited partner, so therefore he is strictly only limited to that 20% of this profit, and that is it, nothing further than that. That is covered on Chapter 8. Chapter 8 is the business insurance section, and it's section 8.2 is the section. Chapter 8 section 2.2. So lowering cap in this case here, general partners, and Raymond is a limited partner. So that word limited is very important because he's only responsible for 20% of the profits, and that's it. 22, and we've got, we don't have a name, so read that over for a moment. Okay, in which of the following situation is the underwriter least likely to request a medical exam to better evaluate the risk of a life insurance? So I'll give you the answer and then we'll discuss it. Okay? A healthy 35-year-old applying for $400,000 of coverage. Okay? So why isn't it A? Well, A says a healthy 25-year-old, that's fine. But look at the amount of coverage, $10 million. Why would a 25-year-old need $10 million, first of all? Okay. Second of all, even if he did need $10 million, okay, they will definitely, because of the volume involved, they will definitely get a medical exam. The amount of coverage is enormous. And so therefore, it's saying, so even if this 25-year-old happens to need $10 million, simply because of the volume involved, the insurance company is going to demand a medical exam. C, a 40-year-old with a history of diabetes, high blood pressure, and kidney malfunction applying for $250,000 coverage. Most definitely he's going to have a medical. Look at all the issues this person's got. He's a diabetic, high blood pressure, kidney that's not functioning properly. So even though the amount of coverage is only $250,000, the risk once again is very, very high. So while A had a risk of too much insurance, $10 million, B, while the amount of insurance is quite minimal actually with today's standards and everything, but look at his medical history. Okay, so therefore the risk is too high. A healthy 69-year-old applying. So, but this person's 69. So at age 69, the possibility that this individual will pass away are quite strong, and prematurely pass away quite strong. So therefore, we're definitely going to have a medical exam, even though the amount of coverage is not exorbitant or anything. It's only $500,000, but because of his age, we will definitely have a medical questions, medical exam. It's going to have to be done. So once again, by process of elimination, a 35-year-old, a healthy 35-year-old, $400,000 would probably be underwritten without any medical exam. Medical question, and that's it. Okay, and that is covered on Chapter 9. Okay, Chapter 9, Section 4.3 is where that kind of thing. So this is a section basically where we assess the risk, you might say, and that's what Chapter 9 covers, is assessing the risk. So Chapter 9, Section 4.3 is where you'll get more information on that subject. Let's go to Lisa on 23. Okay, so what we've got is Lisa. She wants to buy life insurance, and these analysis indicate that she needs a term insurance policy for 20 years with a benefit of $500,000, and she also has a permanent need of $200,000. So she has a temporary need of $500,000, and she has a permanent need of $200,000 to cover final expenses, including taxes, and estates, and so on and so forth. Okay? So she wants to cover her permanent needs, however, with term rider, as she cannot afford the premiums. In other words, she's saying that extra $200,000 is also going to have to be term insurance because I just can't afford permanent insurance. Okay, so she wonders if there's an option for her to be able to continue her coverage after the expiry of the 20-year term policy. So, which of the following riders can Lisa add to her policy that will enable her to continue her coverage beyond the expiry of 20-year term? Well, the first thing we have to establish is that a rider cannot be any longer than the base policy. So if the base policy, in this case here, is of 20 years, but her needs for the $500,000 is 20 years, but the $200,000 is for permanent needs. In other words, beyond that 20 years, she can't do it with term insurance. That's simply not possible because the base is only 20 years. The rider cannot be any longer than that same 20 years. Okay, so the end result is that she has to have something else put into that 20-year plan that will allow her to extend the coverage beyond 20 years. And that answer is convertibility. In other words, at the end of 20 years, if she still needs the coverage, she can convert her policy to permanent insurance without medical evidence. That's the issue here. So she can go ahead and she can buy $700,000 for coverage of term insurance. But if she has a convertibility option, basically at the end of 20 years, says I still need at least $200,000, I will convert $200,000 of my term insurance into permanent insurance, whole life, par, non-par, whatever, okay, but without medical evidence. And that's what the beauty of the convertibility option is, that it's without medical evidence, okay? And that is covered on chapter 5. Chapter 5 and 1.2, section 1.2 will give you the information on that particular subject. And let's go to 24.
What about C option?
Okay, so we got here's Howard. His universal life policy with level death benefit plus account value. The policy face amount is $500,000. When Howard dies, the policy's cash value was $175,000. However, the year before he died, Howard took out a $100,000 policy loan and a 6% annual interest rate. He did not repay any part of the loan before his death. How much will the policy benefit receive as a death benefit? So basically, what this is a question about what we call net death benefit. Okay, and what is the net death benefit? So when an insurance company receives a claim, they actually go through this exercise. What is the actual death benefit? And essentially, the net death benefit is assets minus liabilities. Okay, so in other words, the asset is the face amount. So in this case here is $500,000 plus any extras that he may have. So the extra in this case here would be the $175,000, because remember, he has level plus account value. And so the extra is $175,000 because of the account value. So theoretically, at this point, he's got $675,000 of actual coverage, okay? Because the extra is that account value. It could be all kinds of other things. Could be ADV, could be everything. But in this case here, it is level plus account value. So therefore, the extra is $175,000. So it's $675,000 minus any liability. And the liability in this case here is $100,000. Also, he has 6% interest on that, so $6,000, which he never paid. So the liability is $106,000. So therefore, it is $675,000, okay, minus $106,000, which is $569,000. So if you get a question on the death benefit, it's always assets minus liabilities. In other words, net death benefit is the face amount plus any particular extras that may be added to the policy, minus any loans, any interest, any premium payments that have never been paid, in other words, anything against us. So it's like I said, it's really assets minus liabilities. So in this case here, the assets were $675,000. The liabilities were $106,000. So $675 minus $106, you get $569,000 is the correct answer. And the section that you need to read for that is chapter 4. Chapter 4, and it is section 6.4. So chapter 4, 6.4 is where they talk about the net death benefit. Strongly urge that you review that, because usually it shows up on both the provincial and the certification exam. 25 for Janet. Again, I'll give you a moment to read it. Okay, so what we've got here, Janet, she applied for life insurance with her agent Greg a few weeks ago. So then Greg came to see Janet, of course, to deliver the policy. And when Greg asked if there had been any changes since the day the application was filled out, Janet mentioned that she went for tests at the hospital after having felt numbness in the entire left side of her body, and she's waiting for the results. What should Greg do with regard to the underwriting process? Now, this is a question of basically, essentially, what happens if there is material change from the day you left your client's house to the day you deliver the policy, if there's been a material change in terms of your health, your avocations, your occupation, anything along that line, you need to report that. You need to ask that question. Has there been any change from the time I left to right now to your health, to your occupation, to your avocations, whatever it is, okay? And so therefore, if there's been a material change, then what happens is he cannot deliver the policy because the change to Janice's situation and advise the underwriter of this new development. In other words, in this case here, Greg has to send the policy back to the insurance company and says, I'm sending it back. Here's what's going on. She went to the hospital because she felt numbness, blah, blah, blah. Here's the name of the doctor. Here's the name of the hospital. Let the insurance company now do their investigation, probably an APS, attended physician statement, whatever it is, and let the insurance company decide whether they want to proceed with the coverage or whether they're going to reissue the policy on a rated basis or maybe even decline. It all depends on the situation. So it is very important that if there in fact has been a material change in the client's situation when you deliver the policy, you cannot deliver the contract. If you do deliver the contract and then the client subsequent to that dies or whatever, and they discover that at that time there was an issue, the insurance company could in fact deny the claim. You don't want to get involved in that kind of stuff there. Okay? So therefore, there's a material change in health, occupation, avocation, anything along that lines, hobbies, things of that nature, dangerous sports, things of that nature there, you cannot deliver the contract. You have to send it back to the insurance company with a letter of explanation saying, here's what's going on. What do you want me to do now? Is essentially. That is very, very well covered in Chapter 9. Okay, Chapter 9, 4.1, subsection 4.1, Chapter 9, talks about change of insurability and everything else, material change of the clients upon delivery of a contract. So please make sure that you review that. 26, we've got Linda. So with the help of her life insurance agent, Linda has determined that her current insurance needs are temporary and that $250,000 coverage is sufficient to meet those current needs. However, there is a possibility that those needs will grow as Linda plans on buying her first house in a few years as well as having children. So she's got her life planned out basically. Which rider should she consider adding to her term life insurance policy? In other words, she's really concerned about the future, basically. Okay, and she's basically saying, yes, right now, $250,000 is fine, but I do intend to buy a house, probably have to mortgage it and everything else, like everybody else does. Also, I'd like to have children and everything. In other words, my needs are going to grow. How do I make sure that I can buy more insurance in the future without medical evidence? Okay, that's really what we're asking, without medical evidence, and that is, of course, the GIB rider. The Guaranteed Insurability Benefit rider. Very, very strong, powerful rider in that the insurance company is saying you can buy more insurance in the future without medical evidence. All you have to do is provide just pay the attained age premium. You don't have to provide any kind of medical information, occupation, and all that. In other words, you're fully underwritten now, so we cannot turn you down. So even if you become uninsurable, at a future date, and the GIB option arrives, you sign this form right here. We don't ask any medical questions at all. Okay? So the actual death rider won't work because that is, of course, that only comes into effect if you die of an accident. So that doesn't cover for any additional coverage that she may need in the future. If she doesn't die of an accident, then what happens? Okay, paid up addition rider is again, it could work to a point. But more than likely in this case here, the amount of coverage that she's probably going to need will be quite substantial. And so the likelihood of paid up additions won't work because it is a slow process for paid up additions. Whereas for GIB rider, you can buy a chunk of insurance, and of course, terminal illness benefit, that's critical illness. In this case here, that won't work either. So the best answer in this case here is the GIB rider. And not all of those riders are all covered on Chapter 5. Okay, that's Chapter 5, and in Section 5.1 has all the various different riders. Strongly urge you to make sure you know all the various different riders that are available to your clients. And the GIB rider is certainly one of the better ones, and usually shows up on the exam as well. Okay, so let's go to 27, and we've got Mark. Okay, so Mark was born March 15, 1980, on November the 5th, 2005. He bought a convertible type life insurance policy. The insurance company uses the nearest birthday to determine the attained age. On April the 10th, 2015, Mark converts his term policy into a permanent policy. So he's got a convertibility option. Calculate what would be the age used to determine the permanent insurance premiums if a conversion is made at the original age and if it is made at the attained age. So let me explain, first of all, original age versus attained age. Original age basically means that however old you are. So if, for example, today you're 30 years old, and tomorrow you're going to be 31, in other words, your birthday's tomorrow, you're going to be 31. The fact that you bought the policy today, your original age is 30. Okay, so it's as simple as that. Okay, so therefore, whatever age you are, and that's it. Attained age has two factors. Okay, it is basically as you get closer, 6 months within the new age, you will be charged that new age. So the answer here will be C. Permanent insurance premiums based on the age 26 or original age. Okay, because remember, he bought it in March 15, 1980. November 5, 2005, he bought a convertible term policy basically, but he was born in 1980, so he was 25. Okay, he was 25. However, on April the 10th of 2015, okay, he has turned, and he is now 26. Okay, because it's beyond March 15th, right? So it's April 10th. So he's a year older now, so he's 26. So if it's an original age, it would be age 26. Okay. If in fact it has to be converted at age nearest, then of course it will be much higher. Now I believe that the answer here, conversion at age 35 or attained age conversion, I think there's an error in this question. I apologize for that, but I think there's an error in this. I'm going to make a note here. See, I don't do these, so I don't see them, but I don't think that answer is correct. So what I would suggest is go to chapter 2, 6.2, because they do talk about attained age, original age, and all that. So I just want to summarize that if it's original age, it's basically how old are you today? That's it. If it's attained age, is when is your birthday, and if you happen to be within 6 months of your new birthday, you will then be charged the new age as your attained age birthday. I will check on chapter 20, question 27, because I have a feeling that this question may be wrong, so I apologize for that. 28, and we've got Ben and Michelle. Okay, so Ben and Michelle are married and have a son, Terry. Ben is co-owner of a small company. He and the co-owner, Mark, have just completed a buy-sell agreement that is to be financed by Crisscross Life Insurance. Ben looks after his 35-year-old brother. Okay, so he's got Carson, who lives in the facility for semi-autonomous individuals. So he's got a dependent, basically. So Ben wants to buy life insurance, and all of these people, he wants to buy life insurance, obviously, on all the people that he's surrounded, Michelle, Mark, and so on and so forth. Which of the following individual is not an insurable interest for Ben? So before I answer the question, remember that the question of insurable interest is a question of if somebody dies, what is the pecuniary loss? In other words, is there a loss if that person dies? Okay. If there is a financial loss, in other words, if I'm going to lose because when somebody in my family, for example, will lose because of my death, then obviously they have an insurable interest in me. So you have an insurable interest in yourself. In other words, you can buy insurance on yourself. You have an insurable interest on your spouse, on your children, on your grandchildren, you have insurable on your parents, things of that nature there. Okay. So in order to qualify for insurance, you must have an insurable interest on that individual. So if that individual, there's no connection between you and that individual. In other words, there's no potential loss if that person dies, then you have no insurable interest at all. And so the only way would be is that if you in fact have a pecuniary loss, or there is a particular loss. So in this case here, there is no insurable interest in Carson. Carson has insurable interest in Ben, but Ben does not have an insurable interest in Carson, because Carson is living in a facility for semi-autonomous individuals. In other words, it's Ben who's taking care of the 35-year-old brother. So if anybody has an insurable interest on the is Carson on Ben, but does Ben have insurable interest on Carson? No, because if Carson died, does Ben lose anything? No, Carson is dependent on Ben, and so therefore there is no insurable interest. However, Ben does have insurance on Michelle, his wife. In other words, if his wife died, there will be a loss, a pecuniary loss. Okay, and so therefore it is worth his while to insure his wife. There's also benefit on his son, Terry. So if the son should die, obviously there's insurable interest in the son. He also has insurable interest on his partner, Mark. So if his partner dies on him, obviously he needs to have the money to buy his partner out. Otherwise, he's going to be stuck with his partner's wife, let's say, in this case. So wherever there's a possibility of pecuniary loss, there is insurable interest. In this case here, if Carson dies, Ben loses nothing. Okay, so if anything, Carson has insurable interest in Ben and not the other way around. Now, this question of insurable interest is extremely, extremely important. And so I urge you to read that section very, very carefully, basically, because, like I said, this type of question shows up on the exam. That is on chapter 9, and section 2.2. So I just want to re-emphasize that the child and the grandchild, in other words, Terry, they would be their spouse, any person who is dependent on him. So Carson, of course, is dependent on Ben. All those people here don't have insurable interest, but there is no insurable interest for Carson. Okay, so therefore Ben could not insure Carson, even if Carson was not in a facility. He still couldn't insure him because there's no insurable interest in Carson dying. So go to chapter 9, section 2.2. It's very important. 29, we're just about at the end here. 29, so we've got Mitchell. So once again, I'll give you a moment. Okay, so we've got Mitchell has universal life policy with the face amount plus account value death benefit. On his policy anniversary, it is determined that the cash value of his policy exceeds the maximum taxable actuarial reserve value, making the policy non-exempt for tax purposes. Which of the following solutions will make Mitchell's policy tax-exempt without reducing the death benefit nor incurring any increase in the mortality cost? Okay? So remember that any policies that were last acquired from December 1st, 1982 onwards could be exempt or non-exempt. Okay, so this only applies to policies last acquired from December 1st, 1982 onwards. So any policies prior to that, they're all exempt, so you don't have to worry about that. But from December 1st, 82 onwards, the policies could fall into two categories, exempt and non-exempt. So basically, a policy is exempt as long as the amount of money, the amount of cash that's in the policy, is equal to or less than the maximum taxable actuarial reserve. In other words, it's equal to or less than the MTAR line. So as long as the amount of money is equal to or less than the MTAR, then it is exempt. In this case here, the amount of money actually exceeded the MTAR line, so therefore it has become non-exempt. So the question really is saying, okay, how can we minimize the tax implication here? How can we make sure that we restore the exemption status of this policy? Because remember, if you don't restore it, and you must restore it within 60 days of the anniversary of the policy, okay, the anniversary date. If you leave it beyond 60 days, then you've lost it and it becomes non-exempt forever. So once you lose the exemption status, it's lost forever. So everything we talk about here, if you're going to fix this, so to speak, has to be done within 60 days of notification from the insurance company that you are above the line. So let's assume you do get that letter saying it's above the line. What are the things that you can do in order to make sure that it remains a tax exempt? And basically what we're saying is you can move that excess amount of money into a side fund. Remember that all universal life policies have a side fund. For those of you who listen to my podcast on Wednesday, remember I talked about the side account. All universal life policies automatically have a side account. And that is the reason why they have it. It's that in the event that there is excess money, then that money could be moved over immediately within that 60 days to the side account. And therefore, the money that's sitting in the side account now is no longer exempt. Obviously, you're going to have to pay tax on that. But the money that's sitting inside the policy within the MTAR line will continue to be tax exempt. And that is a very, very important component. Okay. Now, some of the other solutions are, yes, you could increase the face amount. But remember, he basically said that he did not want to have an increase in the mortality. So therefore, he said, no, I don't want to increase the face amount because that increases the mortality cost. I don't want to do that. So therefore, that's why that won't work. But that is one option that could be used. Okay. B will never work. Lower the face amount, that actually makes the situation worse. You do not want to lower the face amount. Remember, you're already at the maximum. So lowering the face amount just really mucks that up real quick. So that's never an option, basically. Withdraw money from the accumulating fund. You could do that, but then you've got tax implications on that withdrawal as well. So that's not a perfect solution. So the real best solution is to basically move the excess money to the side account and leave the rest of the money equal to or less than the MTAR line. So that's where we're at on that particular subject. And so that is covered on chapter 7, 7.6. This kind of question usually shows up in the exam as well, so strongly recommend you read this chapter. Chapter 7 and it's section 7.6 is what we're looking for. Okay, and we are now at the last question. Okay, and we've got Larry, so let's read that over, and we will see what happens. Okay, so what we got here is Larry. He's a member of the employer's health insurance plan, which covers part of his family medical and dental costs. His gross monthly salary is $7,500, and his payroll deductions are $2,500. So basically, his take-home pay is $5,000. So that's the first. So he takes home $5,000 a month, and that $2,500 includes taxes and the whole bit. Okay, everything. So Larry estimates his family's annual dental cost, excluding his own cost covered by his employer's health plan, would be $1,500. The annual medical costs, including prescription drugs covered by the health plans, excluding his own medical costs, are $2,500. So Larry expects these costs to be similar for this foreseeable future. His wife is self-employed, consultant, and does not have any health insurance coverage for the family. On what amount of income should Larry's life insurance needs analysis be based on if he wants his family to maintain the same spending power? Okay. So what we've got, the first thing is we have to look at is that his take-home pay is basically $60,000 a year. However, the other component is to consider that he has a health plan that's available to his employer that covers him for essentially $4,000. Remember, that's $1,500 plus $2,500 of a health plan. Okay, so if Larry dies, his health plan will no longer be available. That's the problem. Okay, so while he's got that benefit, what if he passes away? That benefit's finished. Okay, his family will not have. Now we have to recover that benefit. So therefore, to maintain the same level of spending power and everything else, we need to cover him for $60,000 plus the $4,000 health benefits that will be lost should he pass away. So that would be then $64,000. In other words, we need to calculate that we need enough insurance that will give him an income, an after-tax income of $64,000, because like I said, he is $5,000 a month to $6,000 a year. He's got $2,500 plus $1,500 that his employer now covers while he's working. That's $4,000 a year. He doesn't have to worry about. But when he passes away, he does have to worry about it. His family still needs that particular service and everything. So now that money has to come out of his own pocket based on the family budget. And so therefore, the $60,000 plus the $4,000, $64,000 is what he needs to be covered for. So this was then if you look at the income replacement, so you divide that $64,000, let's say, by the real interest rate, and that will give you the amount of insurance that he actually needs, okay, to cover his family needs should he prematurely pass away. Okay, that is it for this evening. So you should be ready now, having gone through this with me today. You should be ready to write your certification exam. So I suggest to you that you don't leave the certification too long from when we finish these sessions, because this stuff is fresh in your mind right now. So it'd be a good idea for you to go and actually do the exam as soon as possible. Once again, I urge you that if there's any question at all, anything that we've discussed today, please email me at the email address that you have on the website, and I'll be happy to respond as quickly as I possibly can. I'll stay on for a few moments. If any of you type in any kind of question, I'll be happy to answer it right now. So why don't I just be quiet for a moment and listen to you if you have any question. If you don't type in a question, unfortunately, I won't be able to answer because the voice doesn't come out very clear. That's why we don't bother doing it. So if you type in a question, I'll be happy to answer it. But if you're calling me, unfortunately, for whatever reason, it never really works very well, and it's hard for me to understand what you're saying. The taxable policy gain? Sure, absolutely. There's a question in the audience about taxable policy gain. When you're looking at the adjusted cost base, okay, it's the policy gain is based the difference between the adjusted cost base and the amount of money that you're actually taking out. So let's go to adjusted cost base first. What's the definition of that? The definition of adjusted cost base is what did it cost me to buy this, basically, okay? In other words, what did it cost me? So for policies that were issued after December 1st, 1982, in the simplest form, it's a very complicated formula, but for exam purposes, it's really quite simple. What you have to remember is you have to add up all the premiums that the client paid all these years. So let's say that you paid $1,000 a year for 10 years. So you paid $10,000. And let's say also that you have net cost of pure insurance. Remember the NCPI, net cost of pure insurance is $2,000. So, but basically it's the 10,000 minus the 2,000 NCPI gives you your adjusted cost base. In other words, that's what it costs you to actually buy the insurance. Say it's $8,000 during that 10-year period of time. Let's say now you've had $20,000 of cash sitting in the policy. The difference between the $8,000 and the $20,000, in other words, $12,000. Let's say you cash your policy in or you borrow the money. Remember, whether you cash it in or whether you borrow doesn't really matter. Okay, you have a $12,000 capital, basically gain, interest gain. you have to report that $12,000 on your T1 when you do your tax filing. In other words, the insurance company will send you a T3 or T5, basically, saying you have a gain of $12,000, and that has to be reported. So think of that $12,000 as interest gain. And as you know, whenever you're filing your taxes, if your bank sends you a T5 showing you interest, you have to put that as part of your income for that year and pay your taxes. It's the exact same thing here. So the policy gain basically is the difference between the adjusted cost base and the amount of money that you actually took out. I hope that helps. Thank you. Anything else? I won't go back to the question, Karina, because like I said, the question is not very well, but I will explain it to you again, okay? When we're talking about the attained age versus the original age, what we're really saying is if you are today 25 years old, so if I ask you today, how old are you right now? Say I'm 25, okay? I don't ask you about your birthday here. You are 25, okay? And so therefore that is what we call it. In other words, if you turn 25 in, let's say, just as an example, September the 1st of this year, you turn 25. That's your original age, 25. Okay? So that's fine. So some companies will say we use original age, and so therefore, so September the 1st you turn 25. September the 1st, 2017, let's say, you turn 25. So up to August 31st of 2018, if any time you bought a policy during that period of time, if you're using the original age, you would be 25. Okay, so that's what they refer to as original age. If they refer to attained age, that means that September, 6 months after September, so September, October, November, December, January, February, March, up to March, you will still be 25. But in April, because now you're past the 6 months, so you're closer to your new birthday, you would be 26. You see, so as you become, so if you buy an insurance policy, within 6 months of your new birth date, you will be the new birth date, so you'll be 26. So if you use original age, you never have to worry about that, okay? Because the entire year is the same age, doesn't matter. But if you use attained age, the moment you are past the 6 months from your birth date, so in other words, you're closest to your new birth date, that will be the new age that they will use. That's what they call attained age. I hope that helps. I know it gets kind of confusing, and the question's not very good, so I do have to check that out and make sure we correct that. You're welcome. Anything else? The GIR, there's a question about the GIR. Are you talking about GIB or GI? GIR is not, you're talking about GIB, I'm sure. Guaranteed Insurability Benefit, or guaranteed, sometimes they call it GIR, I realize that. It's really an excellent benefit. Let's say that you were 25 years old and you just finished school, let's say, and your income is pretty low, so therefore your needs are pretty low, so you only insure yourself, let's say, for $250,000. So that's all you need for now. Right? However, your income is going to grow, and you're going to buy a house, and which will have a mortgage. You're going to get married and have children, and all those things there. So in other words, as you go along, your liabilities will be increasing. Okay, so therefore that means that your insurance needs will also be increasing. Every insurance company out there will be very happy to insure you as long as you are insurable. But what if something happened? You were 30 years old and suddenly you had a nasty accident oh, you got cancer or whatever. In other words, now you need more insurance, but you are uninsurable. And no insurance company will touch you. Right? However, you were smart. At age 25, you decided to add a GIB rider to that $250,000. And let's say that you added a $50,000 rider onto that. So in other words, every time the option comes up, you can buy an additional $50,000. So at age 30 rolls along, the option has come up. Usually it comes up every 3 years or so, okay? And so you don't have to worry about the 3 years because the insurance companies automatically will send you a letter when that option comes up. And you've got 60 days to make up your decision. So let's say, for argument's sake, you bought at 25 and the option came up at age 31 or something, and you're insurable. But because the option has come up, now you can buy $50,000 out medical evidence. All you have to do is pay the attained payment rate at age 31. That's it. But they will never ask you any medical questions. And then 3 years from now, the option comes up again, another $50,000. So the GIB rider allows you options up to age 50, 55, then it falls off. Okay, it falls off at that point. So you have a number of options that you can buy. So we usually recommend a GIB for younger people like yourselves, for example, that are just starting off in your careers and everything else. Your needs are going to continue to grow. Your insurance needs are going to grow. And like I said earlier, every insurance company will be happy to insure you as long as you're insurable. But what if you're not insurable? That's the issue that we always have to face, is that we could render ourselves uninsurable. And so how do we protect ourselves against that? You buy a GIB, and that ensures your insurability. The other area where GIB is very, very useful and strongly recommended is if you sell a child's policy. So the parent wants to buy $250,000 on their son, for example, and wants to make sure that at any time, once the policy is transferred over to that child, when they are adults, they could buy more insurance in the future without medical evidence. And once again, GIB is a very good option. So we usually recommend when you're dealing in children's insurance policies is that you add a GIB rider. You don't know what's going to happen to this child. They may get a serious childhood disease and end up uninsurable. But when that GIB rider shows up at age 25, it's usually when they start at age 25, and then every 3 years after that, they can buy more insurance without medical evidence. That's the key. Okay, I hope that helped. The after-tax return is basically you take the rate, your rate, let's say, 6%, whatever is the rate, and then you have to multiply by 1 minus your tax position. Okay, your tax position. So if you're in a 44% tax bracket, okay, that is 1 minus 0.044. Okay, and so it's 0.44 rather than 0.44. So it's 1 minus 44% basically, so 0.44 times the 6%. That's how you do the after tax. Because remember, if you're in a 44% tax bracket, let's keep it simple. Let's say you're in a 40% tax bracket. That means the first $40 of $100 is gone. So all you have left to spend is 60. You see, that's the issue. So what happens is, in order for you to have $100, let's say, to invest, and let's say you were in a 40% tax bracket, you divide the 100 by 60%, and you realize that you have to earn roughly $145 in order to make sure you have $100 left to invest. So when we're talking about after-tax interest rates, you take the interest rate, so let's say in our example with 6%, times 1 minus 0.4, because it's 40% with the tax bracket, okay? So you multiply that, so in other words, it's 1 minus 0.4, that's 0.6. 0.6 times 6 basically is 3.6. So therefore, your after-tax interest is 3.6. I know it gets confusing, but the book has got a very good example. So you might want to go back to the book and take a look at that because your question is very important, because on the exam, they usually will have a question about after-tax investments, after-tax insurance, and so on and so forth, okay? I hope that helped. that is, I guess, the end of the session for today. We will be back next week, where we will be discussing the accident and sickness side of the formula, basically. So I hope to see you all at that time. In the meantime, if